Welcome to another CSEC economics lesson. The topic for today is national income statistics, and we will look specifically at GDP, GNP, and NI. So, for our objectives, we will interpret gross domestic product, gross national product, and national income. So, what is GDP? Now, GDP measures the monetary value of final goods and services. So, those that are bought by the final user produced in a country in a given period of time. And the time period is usually a quarterly basis, or every 6 months, or a year. So, it counts all the output generated within the country. So, everything that's produced within your country over a particular period, the market value is added to GDP. GDP will also include some non-market production such as defense or education or services provided by the government. There are three approaches for measuring GDP. This includes the expenditure approach, the income approach, and the output method. So the expenditure approach will add up expenditure in the economy. It will look at consumption expenditure, investment expenditure, government expenditure, and net exports. That is exports minus imports. And then the income approach looks at adding all the various types of income, that's rents, wages, interest, and profit. So it adds the incomes generated by the factors of production. And then there's the output method, which is the total or the sum of the value of final goods. It is important to note that all methods of calculating GDP should give the same result. So the income, the expenditure, and the output method should all be the same. Now, there is a distinction to be made about factor cost and market price or market value. So the GDP, when we look at GDP at factor cost, we are removing the influence of indirect taxes and subsidies, as those would have altered the price. So we're looking at the point where we look at GDP based on what it costs, or what it costs to produce a good. GDP is usually considered as a good measure of economic well-being, and sometimes you will see reference being made to GDP per capita, and this refers to GDP divided by the population. And this gives an idea of the average income or output based on the total population of an economy. GDP is an indicator of the level of production taking place within an economy because it measures the value of the market value of the final output, and it is used to make a determination of whether there is economic growth by comparing GDP over different periods. So for instance, the GDP for 2019 and 2020 can be compared to have some idea of whether the economy is growing or producing more output. And it is considered to be a good indication of economic welfare because there is some correlation between economic growth and economic development. There are some limitations to using GDP as an indicator of economic welfare. So some of these limitation includes that it ignores non-market activities. So things that people do for themselves at home, maybe you have a garden at home and you plant some foods that you eat or that your family also consumes, that is not included in the GDP because those goods never actually go to the market. Or maybe you have a skill and you usually would charge persons to do things like do hair or makeup. But if you do those things for yourself or for members of your household and you don't collect any payment for it, that would not be included in GDP. It also ignores black markets or illegal activities from which income is generated. It ignores the disparity in income distribution. So, if a country has what is considered to be a high GDP, but it has a very unequal wealth distribution, by looking at the GDP, it's not giving you a clear picture of how each person in the economy is doing. It gives a larger view of economic welfare, but on an individual basis, it does not transfer. It also ignores environmental degradation, which takes place based on how the natural resources of an economy are being exploited while production is taking place. In addition, it does not account for improvements in the quality of goods or services provided. Another concept is gross national product, and this is another national income statistic, and it looks at the total monetary value of all goods and services produced by the nationally owned factors of production. So it includes the value of the things that are produced locally, but it also looks at the value of things that are produced in other countries but are owned by nationals of that economy. Now, if you know the GDP, deriving the GNP is done by subtracting the income payments to foreigners and adding the income payments from abroad. So you do have assets locally that are owned by foreigners, so we have to subtract those income payments and then take into account our income payments from the factors of production that we own abroad. So remember, GNP is equal to GDP minus income payments to foreigners plus income payments from overseas operations. Now, the GNP is also a means of making some judgments about how an economy is doing. While GDP focuses on production, GNP focuses on income. You can also look at the GNP at factor cost, similar to how you would look at the GDP at factor cost. GNP at factor cost would be GNP minus indirect taxes plus subsidies. And there are other ways that you can write this formula. So you could look at the GDP at market price plus the net property income from abroad. Those two would give you GNP. Then you can add subsidies and minus indirect taxes. Or you could look at GDP at factor cost plus net property income from abroad. Remember, the GDP at factor cost would have already accounted for the influence of indirect taxes and subsidies. So just adding the net property income from abroad is what would give you the GNP. So as mentioned before, GNP is really an indicator of real income rather than that of domestic output. There are limitations to GDP and there are also limitations for GNP. So when we're looking at GNP, it is good to take into consideration that it is influenced by the foreign exchange rates. It ignores an accurate representation of how local resources are used, and it is also not a good indicator of economic growth and contraction since it focuses more on income rather than production. Another national income statistic is national income otherwise called net national product at factor cost. And it is the GNP at factor cost which also accounts for depreciation or replacement capital. So remember, national income or NNP at factor cost is equal to GNP at factor cost minus depreciation, otherwise referred to as capital consumption. And the national income has some similarities to GNP with the expectation that it accounts for the adjustments for depreciation and it eliminates the distortion caused by subsidies and taxes.